Welcome back. This is Open Exchange and you're watching us live from the CNBC-TV18 Motilal Oswal studio right here in Mumbai. We're beginning another brand new day of trade and looks like it's going to be a quiet session. We have a market holiday tomorrow as well, but there's F&O expiry, so maybe some volatility towards the end of trade. But let's get talking to Deven Choksi. He's still with us. Deven, what are your thoughts on how to approach some of these auto names now? Because, there are a lot of reports about how there's some recovery coming through, especially in the export market. But the numbers are not suggesting that just yet. Would you buy any of these two-wheeler names now in anticipation of a recovery, or are you still cautious there?
So two-wheelers are already beaten down, and I think if the recovery is genuine and real and sustainable, then possibility of, stock price recovery definitely is asking for it. In my viewpoint, I think it is still too early to conclude that part that the market demand and the recovery in the export market is fully stabilized. I think we'll have to wait for a couple of more months, to see actual stability happening. But I think the valuation-wise, they have already come down and they are quite attractive probably, particularly the likes of Bajaj Auto, where it holds maximum amount of promise if the recovery in the export market takes place. However, to be on a safer side, I would probably go with the commercial vehicle, where I see the visibility of at least next 3 years going forward as far as the demand scenario is concerned. I think the higher amount of economic activity taking place both in infrastructure as well as in industry. B, the scrappage of vehicle policy is coming into force, and as a result of which the additional demand is also coming into play. I would think that along with the costs of production remaining under control due to the metal prices remaining comparatively stable, I would think that commercial vehicle would be one segment which will probably not disappoint investors. It will probably give better appreciation in the portfolio within the auto pack.
Okay, so commercial vehicles you're saying is the one pocket that will not disappoint. Any ideas there? I mean, is it just Ashok Leyland that you plan to stick to, or anything else that you like? Because the other commercial vehicle players have, other angles as well, right? I mean, Eicher has Royal Enfield, Tata Motors has its passenger vehicle business. So as a pure play commercial vehicle maker, would you stick with Ashok Leyland? Or are you even looking at, some of these names like, say, a Jamna Auto, something in the broader markets, maybe ancillary companies that cater to this space?
Yeah, so an important point actually. I think pure play Ashok Leyland definitely is looked into. But even the improvement in Tata Motors domestic passenger vehicle business also suggesting that along with the commercial vehicle business, I think Tata Motors should be looked at very favorably from the investment perspective. And not to forget some of the key auto ancillary companies which are catering to OEMs. I think they would remain definitely, the choice to add into the portfolio. Fortunately, they are in the mid-cap space. I am saying fortunately because they have corrected significantly from the price at which they were quoting. Some of them definitely for sure. And they are available today at a valuation which is not far too expensive, which it was, earlier. So from that perspective too, I think the downside risk is limited. And I think the commercial vehicle along with some of the select auto ancillaries could definitely be the portfolio composition as far as we are concerned going forward as well.
Okay, all right. Deven, stay with us. Let's get some F&O trades out of the way as well. Rajesh Palvia is Vice President, Technical and Derivative Research at Axis Securities. He's with us. Rajesh, good to have you with us here. It's been slow burn and the market's not done very much. It doesn't look like we're going to have a very exciting day. What trades would you want to take?
Good morning, Prashant. So overall setup is bearish and sell on rise is the strategy for both the indices. Both the indices are stuck in the tight range, but looking at the data setup, looking at the rollover activity till now, almost it's a more than 3 month, 6 month average for both the indices. Even market-wide rollover is also higher than 3 month, 6 month averages. Looking at the setup, we believe that one should remain on the sell side of the trade because Nifty is having major call concentration for today's expiry is at 17,000 strike, and put writers are also covered their position in the previous trading session. So it clearly shows that now the case for staying above 17,000 is also looks weak for the day, and we believe that again Nifty may retest the level of 16,900 to 16,850 in the continuation of this supply pressure which we are seeing since last couple of trading sessions. It's a fourth consecutive month where we are seeing that Nifty is now giving a negative expiry. This is happening post 2016. So again, it clearly suggests that the trend is on the negative side. So we believe that one can initiate put for 17,000 strike of April series at of 6th April of which is closing at around 133 rupees. So one can buy this put of 17,000 strike. We are expecting target of 190 to 200 for this put option, and one can place a stop loss of 100 rupees. So 6th April put one can buy for the Nifty. On the stocks front, we believe that automobile stocks like Eicher Motor is looking weak, and we expect that furthermore downside we can see in this stock. Short built up is there for this series, so we are projecting target of 2800 to 2780 for Eicher Motor on the downside for April series. So one can initiate short with stop loss of 2930. Another stock on the short side, that is from IT space. Clearly, IT stocks are under pressure and short build-ups are there in the most of the IT stock. So we have selected here HCL Tech to go short for April future. We are projecting downside target of 1010 to 1000 rupees on the downside. One can keep a stop loss of 1090 to go short in HCL Tech. One stock which we like on the buying side, that is Alchem Lab. Long built up is there for this series, and looking at the technical setup also, stock managed to hold its near-term, short-term moving averages. So Alchem Lab one can buy for upside target of 3320 to 3350. One can keep a stop loss of 3220 to go long in Alchem Lab.
Okay. All right, thanks a lot for that, Rajesh, for joining in, giving us your view on markets as well as individual stocks. Well, it's time for our Momentumizer segment, and the one that I'm looking at is Manappuram Finance. Remember, the stock, in fact, has been a big outperformer in this month itself. So there was pressure on these gold finance companies, but I think the spurt in gold prices has led the market to believe that maybe this is another way of playing it, because footfalls will increase, your asset quality as well will not go bad. And it's perfectly depicted because broader markets have been in pain, but Manappuram Finance has done pretty well. Yesterday, the stock as well was up close to around 3% in otherwise wobbly market, and traded volumes were much higher than what we have seen in the previous 10 sessions, though delivery volumes were more or less in line. What was heartening to see yesterday was it crossed crucial technical levels, the 20, 50, 100 and even 200 DMA. It's trading above those levels. Now you'll wonder whether or not it has enough in it to go up by another 5 to around 6% odd and go to its highest levels we've seen all the way since April 2022, where in fact it went to around 126 rupees. So let's see whether or not that can happen. For starters, it's opening up a bit in the red, but important technical levels at lower levels. So let's see how it goes.
Okay, we'll keep an eye out on that. And it's had a fairly decent run. I mean, in the last 1 month, the stock is up almost 15%. So looking pretty good over there. But let's move on and talk about how gas prices are expected to be revised from the 1st of April. The gas panel reports a key recommendation is for prices of natural gas to be between $4 to $6.50 per MMBTU. Harshvardhan Dole, who's the Vice President Institutional Equities at IIFL, joins us now to talk about that. Harshvardhan, thanks a lot for joining in. Can you tell us what could the impact be on gas producers once this revision, if and when this revision comes through? What kind of impact do you see on their earnings?
See, one should not look at just the near-term earnings for some of the gas producers for two reasons. Firstly, the current gas prices which are there in the spot market are significantly higher, and these are not sustainable. So even if these gas prices get reset to a lower price of say $6 to $6.50 per MMBTU, it will actually bring in some correction in the earnings, but it will also bring in stability over the medium to long term, because the price formula allows a reset of 50 cents per MMBTU periodically. And it has got an indexation to oil basket. So to that extent, it will bring in predictability over medium to long term. And that's what we actually like from producers as well as consumers perspective, that the largest suppliers will get stability and the largest consumers will actually get uninterrupted supply at a reasonably predictable price. So it's a win-win for all.
In terms of changes, Harshvardhan, morning, basically there are two, right? One is that it'll be linked to oil and not international gas prices, right? So gas prices will be at a slight slope to underlying oil prices, and second is there is a floor, unlike before, right? These are the two main changes which are of relevance.
That's right. And of course, there is a priority which is being proposed to the city gas distribution companies, which in a way are single largest consumers, which are consuming at a most fastest pace. We all know that there is a gas capacity which also requires gas, but gas at a much cheaper price. And to that extent, CGDs are the largest asset class who are consuming gas in a meaningful way and who are projected to drive the overall consumption of gas. It is, and therefore, this relatively lower or benign price environment ends up benefiting them the most.
Okay.
So do you expect city gas companies to re-rate if the proposals, as is expect, no reason why they should not be approved, city gas companies to re-rate a little bit post this going through?
That's right. In fact, city gas distribution companies like IGL, MGL, or to matter even Gujarat Gas, when we speak to them, they are expecting a benign gas price environment to further accelerate their sales growth, particularly on the CGD side. And that's mainly because the differential between petrol and diesel versus CNG had narrowed down considerably over the last 12 months, because the CNG prices had gone up anywhere between 36 and 40% across the country. And to that extent, any breather or any correction or cool down in the raw material prices will mean these companies pass on benefit to end consumers to a great extent. So the attractiveness of CNG to the alternative fuel improves, and that should benefit these companies quite materially. So logically, IGL, MGL should do well, and
Sure.
between these, definitely like IGL.
Okay, the other stock whose underperformance has been quite puzzling is Reliance Industries. I mean, there are, of course, reports suggesting that there seems to be no major catalyst in terms of a growth trigger for them. There's high capex as well, which could put pressure on the books, etc. But how are you positioned on Reliance now for the medium to long term?
See, in our opinion, Reliance, most of these concerns that, massive capex or volatility in the O2C business or deferment in ARPU increase in Geo and, some of the poor disclosures on the retail side, these more or less are priced in at the current market price. And we are, positioning this stock as one of the preferred stocks in the large and mega cap names. And to that extent, the risk reward seems to be quite favorable. And if one does back of the envelope calculation, then the implied valuation of retail business is probably 20 to 22 times on FY24 EBITDA, or implying a valuation which is at par with, when Reliance raised money from various strategic investors. So to that extent, the valuations are far more reasonable now. And the underperformance should end once one gets clarity in terms of the tariff increases, particularly on the telecom side.
Okay, got that. In fact, let's take this discussion forward. Harsh, thanks a lot for joining in. Sonal is here to tell us what key brokerages are making of Reliance and the underperformance it's seen over the last many days. Sonal.
Well, yes, it's another report that we are getting for Reliance Industries in just last few days. Let me start with what Macquarie is saying here. They have upgraded the stock to neutral from an underperform, but their target price is still at 2050, which is still lower than the street estimates. They still see consensus EPS cuts, but now it's a balanced risk reward according to Macquarie. They forecast 6% growth in 2-year net income CAGR for Reliance, while consensus is more optimistic versus Macquarie at 15%. They could get more constructive on Reliance Industries in a scenario where the company is on the path to deliver on consensus forecast earnings with respect to free cash flows. New energy, fintech verticals show evidence of growth for the company going forward as well. We also have a note from JP Morgan where they have gotten some investor feedback. They have an overweight rating with a target much higher at 2,960 rupees per share. There is value according to the investor feedback, but no recent catalysts. There is higher capex, lack of retail disclosures, which are the key issues which investors have spoken about. However, multiple catalysts will play out from calendar year 24 onwards. Stronger retail, potential tariff hike, lower capex, progress towards potential IPOs. So largely the underperformance is led by lower flows into the stock, and that is something that could be the key to watch out for Reliance Industries going forward as well.
All right, thanks a lot for that. The other stock quickly before the market opens that we're looking at is Bajaj Auto, because JP Morgan has a positive note on Bajaj Auto. They maintain an overweight. They have a target price of 4,400, which is their base case. Their bull case is a 41% upside to the current market price, and they say that that could come through if exports bottom out as planned. There's a potential recovery in exports from Q2 that's expected. Also, there's a new premium motorcycle launch under the Bajaj Triumph JV, and that's a positive trigger. They're expecting 40,000 volumes by FY25 from the Bajaj Triumph launch, and the EV launches could also be the next big trigger for them. Bajaj is expected to launch several new two-wheeler electric vehicles over the coming quarters, and they will be launching a new three-wheeler EV by Q1 of FY24 as well. In fact, when I mentioned the new premium motorcycle launch, I saw Nigel suddenly his ears perked up. You're interested in that one? I mean, it's expected to be a beauty.
Yeah.
So I don't know.
I mean, 2024, I'm definitely looking at new set of wheels. So good, more option for me.
Absolutely, and that's a big trigger as well. Just 10 seconds left for the market to open, by the way, so let's focus on that. Looks like it's going to be a quiet opening, so, we'll sort of take it from there. It's been a very range-bound market, and that's the first take on the index as well. Sensex and the Nifty absolutely quiet. The Nifty just hovering around that 16,980 mark. Now up about, 0.15%, so very, very quiet over there. Sensex down about 40 odd points or so. The advanced decline ratio also skewed absolutely, straight down the middle. So there's no indication of which way things are headed. The mid-cap index is holding up a tad bit. So no directional call over there, just 40 points higher for the mid-cap index. And the Bank Nifty is the one that's batting for the bulls this morning. So both the PSU Bank Index and the Nifty Bank are holding in the green, up about 0.2%. In fact, good to pull up some of the banking names as well to see which are the big gainers. By the way, the other pockets that are looking good this morning, the Nifty Auto Index is up about 0.5%, and the Pharma Index is doing well. The Metal Index also is holding up with gains of around 0.2% or so. Some of the big movers coming up on your screens. Reliance is dragging its feet, actually. It's been a big underperformer in the last many days, and that has been puzzling. Reliance, despite a lot of brokerage reports coming through, positive ones at that, Reliance is still down about 0.2%. Other names in the banking space are largely quiet. So HDFC Bank, Axis, ICICI Bank are holding up in the green, but not by a large amount. Just about 0.5%, maximum 1%. Federal Bank, Punjab National Bank, Bank of Baroda absolutely quiet at the moment. On the downside, though, you have, let's check out what's happening with the IT names, because there has been a bit of pressure there. In fact, in the month of March alone, names like Infosys, Wipro have been down about 6 to 7 odd %. So this morning as well, the Nifty IT index not doing too much, up about 0.3%. Infosys largely flat, a couple of others like TCS as well, just hanging on to the green line at the moment. A big move on South Indian Bank this morning, down about 15.5%. So just keep an eye out on that. And there's a deal on Max Financial that has also taken place. About 30 lakh shares have changed hands, so just keep an eye out on that as well. But of course, Nigel will take that forward. For now, decent opening, Nifty hovering around that 17,000 mark, minor gains seen, but then again, it's been stuck in this very tight range.
Well, that's right. So at the point on South Indian Bank, the MD and CEO, Mr. Murali Ramakrishna, will not be reappointed, and their search committee will be looking for a new candidate. So that's the announcement that hit exchanges yesterday. I think the street has not taken that personally, though. I think he had mentioned that it's the reasons is due to personal reasons, family circumstances on completion of his current term. Remember, the current term goes on till September 2023, but he will not continue from that. So that's why that stock is under pressure. A few more names, though, that are in focus. SML Isuzu, they've taken a price hike. The street likes that. The stock is up close to around 3%. 4 to around 6% is the price hike from April 1st. So that one's up and about. Jindal Stainless, they're looking at backward integration. For the time being, the street likes it, that they're putting close to around $150 million odd. Stock has seen a big correction, close to around 15% just in the last few days from the peak. So that one as well is up and about. NBCC, they won an order to the tune of around 147 crores odd. So that as well opened up with a gain of around 1%. RHI Magnesita, the board will be meeting in the next couple of days. That's on April 1st. They'll be considering fundraise. We know that they wanted to raise close to around 1,500 crores. On that day itself, the stock was down nearly around 8 to around 10%. But now the promoter entity will put in close to around 200 crores out of that 1,500 crores. So the street likes that. The stock up close to around 2%. Good going, guys. We are 4 minutes into the trading session and we're up 60 points. And we're still in the green.
Yeah, we're still in the green. 60 points. No, absolutely. Banks, by the way, I think is what is doing bulk of the heavy lifting. So I'm just looking at the index contribution. It is three names. HDFC Bank is adding about 12, 13 index points. ICICI about 10, and HDFC Limited is adding another 8, 9 odd index points or so. So that is about 30, 35 points straight there from these three names that you have. Then there is HUL and ITC. So it's banks and the top two FMCG names which are contributing. Reliance actually is pulling the index down a bit by about 10 index points or so. Kotak and IndusInd, which did well, better as compared to the others recently, are a little lower as well. Now, let me just quickly take a look at the broader market and see if, which are the big ones. There is Quest Corp, which should come up on your screen. I'm sure there are some blocks which have happened. There's a large trade, yes. It's up 6.5%, 366 on Quest Corp, and 4.5% equities changed hands. So that's a big one. Minda Corp sold off yesterday. It's actually been all over the place last 3 days. It's up 8.5% on good-sized volumes. Minda Corp, that is. I can spot GR Infra. I think they've emerged as the L1 for a large-sized order. It's up 5%. I think it's around a year old plus listing, GR Infra, maybe a little longer. ITI is up 5.5%. Volumes are thin. I mean, if I go down the list, so don't want to do that. Shalby Hospitals is coming up with about 8% gain. Borosil Renewables is up about 6.5%. These are large moves, but the last two are not backed by significant volumes. The one big name, I think, on the downside, which we've already mentioned, is South Indian Bank. It's down 15%. Hindustan Zinc is down 9%. The adjustment taking place 298. Nika is been selling off all week. This week. For the week, Nika is down. I mean, that is. And when I say week, we're just on Wednesday. Last Friday to this Wednesday, stocks down 9%. Nika. So 125, 126. And there is Symphony, which is down about 5.5%, 6% as well. The other pack is the Adani Group stocks, right? I mean, I think we were talking about this was, of course, what we were talking about. Adani Total Gas is down 5%. Adani Transmission is down 5%. Adani Green is down 5%. Power is absolutely flat. Adani Ports is up 1%. ACC and Ambuja are flat as well. One is down a third, the other is up a third of 1% or so. Sonia.
Just one stock I wanted to mention is Tube Investments. If you remember last month, Renuka Ramnath's multiples had invested 1,200 crores in Tube Investments Clean Mobility segment, TI Clean Mobility. They're very bullish on the electric vehicle, commercial vehicle space. Now, this morning, once again, there's another fresh investment from multiples. They've invested 266 crores in addition to the 1,200 crores last month. And State Bank of India has also invested 133 crores in TI Clean Mobility. So they're going big in this, clean mobility, electric vehicle space. And that's another stock that's gaining ground this morning. Absolutely.
We'll keep an eye out on that one as well. 0.75% higher is what we have. 30 points, by the way, on the Nifty. 16,983 on the Nifty. It's flattish as was expected. Now, Venugopal Garre is joining us. He's Managing Director at Bernstein, and he's with us now from Singapore. Venu, great to have you with us here. Thank you very much for your time. You've been sort of meeting with chief investment officers across some of the largest Indian mutual funds extensively. So many meetings. I just want to kind of start by asking you, what are the key takeaways? What stood out for you from a sort of India investment landscape perspective from here out?
Thanks, Prashant, and thanks for having me on the show. Yeah, so I of late have been meeting quite a few of the CIOs across the world, including in India, and I would probably say that I was a bit surprised because I was expecting a sort of a bearish sort of a sentiment, on the ground, especially given what was happening in the global economy. And this was a time about a few weeks back when we had actually seen a round two of concerns emerging globally. And apart from that, domestically as well, as the situation where macro has been slowing down and there were certain areas of concerns emerging, what I sort of observed is that there was very clearly an underlying bullishness that was sort of there in my conversation that I could hear from them. And I guess the broader thinking from a top-down point of view that I could gather is the fact that there is broadly a consensus emerging that perhaps we are more close to the bottom in terms of GDP growth rate. So maybe we don't really see any incremental GDP dent from here. So that is one major aspect. And the second thing, I guess, is also the fact that we've seen a time value correction in the markets for almost 18 months. It's been moving sideways. So to that extent, with earnings not really seeing any major cuts, we've actually seen some valuation correction as well, which was also cited as one factor, important factor. And third thing, I guess, is I saw that there was this perspective that flows from a domestic point of view perhaps will still be sticky for a while, despite interest rates moving up, which was, again, perhaps a sort of a unique takeaway. So which is the broader thinking from a top-down point of view. I just want to quickly highlight the sector views that emerged because it sort of diverges from this top-down underlying bullish view. Because I think most of them were negative on IT services still. They were negative on consumption overall. There was positive on financial, but still very skeptical. And the big positive areas that I felt, underlying was autos, industrials, where there was positivity, but these are very small sectors. If three of the largest sectors, either you are not positive or a bit skeptical, then I think the top-down view doesn't really marry the bottom-up view. So what primarily means to me that there is still this potential for, a relatively lower return environment, which is still emerging from there. And I guess it is more a question of a 3-year view or a 2-year view rather than the next 6-month view in terms of how most of the top CIOs are looking at things.
So, Venugopal, just to summarize what you've said so far, are you trying to say that if we are close to the bottom in terms of GDP growth, there has been a time correction now for 18 months and perhaps pricing in a lot of the bad news, do you think the worst for the Indian equity markets is over? And are we staring at some sort of, bottom formation and then perhaps a leg of an up move in the second half of 2023? Is that a fair way to look at it?
Sorry, that's a fair way to look at it. That's basically what my original thinking was, that second half of the year, I should start to look at things positively, the Indian market. That was my original view as well, which was the outlook view. But my thinking was primarily that, you have to see a convergence of a lot of things apart from GDP. See, GDP at 4.4 can't go to 3, right? So we are very clearly going to move sideways on GDP from here, maybe not much of a correction. But then the global economy, we need to really see where things head. Because I guess directionally, we're still not sure of where interest rates peak. We're not still sure of, the direction in terms of what kind of a recession we're going to see. In my perspective, simply around there is that there could be a protracted downturn globally. So what it means is that when we talk about a recovery in the second half of the year, the slope of the recovery is still a question that I have in my mind. At this juncture, I'm thinking of probably a positive view if index falls below 16,000, for example, in the second half of the year. But then the point is start to buy. But then how much returns can you make? Are you going to make 25% returns from there? I don't think I'm in that camp. I'm basically still talking about positive returns in second half. So that's the way I would probably construct it given the uncertain environment that we are still in.
Hi, Mr. Gare. Good morning. We ask a lot of guests out here about how things are different currently from 2008. And you have written a nice detailed note that things today are very, very different from the global financial crisis. That's heartening from my perspective at least. Give us a few details and why you believe this time it's very different.
Yeah, Nigel, so basically the world is worrying about GFC, right? And the point is that on the top of it, you'll basically see a lot of similarities. And given that people tend to be, looking at similarities and, sort of think that the same outcomes would emerge, unfortunately, my viewpoint is very different from what I've actually seen being written globally. Now, my thinking simply is that, look, the differences are very, very clear and stark. At this juncture, I don't see it as a consumer problem. And when I'm talking about it, I'm probably talking about US, for example. It's not a consumer problem. That was basically a consumer problem at that point of time, especially around, mis-selling of loans, even the credit quality or scores at which loans were being given were very, very different. So you primarily saw a situation when interest rates, increased. There was a pretty large problem with MBS at that point of time. But at this juncture, you see primarily a situation where it's an interest rate-led impact on investment books of banks. Now, that backstop can be supported through liquidity, which is what Fed is doing. So this is not a permanent damage to the quality of the assets. It's basically a temporary damage, right? So that liquidity can manage. The second thing is what I see is policymakers this time globally. You've seen that not just in US, but also in Europe recently with what happened to CS. The reality is they're acting really fast, even before problems emerge. so as to ensure there is no systemic risk that can ripple down, the overall financial ecosystem in the world. The third most interesting thing is the fact that global cycles haven't converged right now. 2003 to 5, 2003 to 8 was a global synchronous upturn. So there was sort of excess froth everywhere. But you look at the current situation, end of the day, 3 of the largest economies of the top 5, China has not really seen much growth in the last 12 to 18 months. So they're in a very different cycle at this point of time. India, I would still call it early cycle in the sense that our economy basically is still higher than what we were in 2019, but not like majorly higher. So we're still early cycle, even though when we're weaker at this juncture. So what it means is that, even globally, there are some countries which might still hold good. They won't really fall too much in terms of economic growth. Well, you might see some moderation in US. So it's a balance at this juncture. So this is a top-down view. There are a lot of other details that I mentioned in the note, but my perspective is that don't expect shocks, which is systemic shocks. There are checks and balances which will ensure that will not happen, which primarily brings down the view that the interest rate trajectory to bring down inflation as an effort will continue, but then which means that you're not going to see immediate recoveries as well. Probably it's a 2-3 year pain that we'll have to go through, volatility, some recovery months, some weak months. That's the way it's going to be.
Venu, you also had another interesting report on China Plus One. Now, local manufacturing, there's always a fair degree of hope. Sometimes it gets into the exuberant zone, and sometimes it the ebb and flow is there. But on the ground, I think you've looked at where are global companies shifting capacities, and does India figure prominently there? So just your takeaways and your findings.
Yeah, so I mean, you're right. Everyone is positive right now on India manufacturing story. But I think there's always a question of what is the magnitude of being, how much should be positive? Is it positive for 1 or 2 small mid caps, or is it positive for the economy today or 10 years later? So what we tried doing here is we tried putting numbers to this. There are about 135 global brands, as I call it, which have taken about 200 decisions in terms of manufacturing shifts over the last 5 years. Now, what we observed is, and in fact, we've done a similar exercise about 3 years back. At that point of time, there were 75 companies with 100 decisions. Now, this 135 is cumulative. So the interesting thing is that at that point of time, primarily India was one of the beneficiaries with 10% allocation of those 100 decisions going towards India. Overall capex of those 75 decisions was about 30 billion. So India was getting probably less than $3 billion in terms of even capex investments around those manufacturing decisions. But in the last 3 years, what we have seen is incrementally out of these 135 sort of companies, almost 14% allocations have happened towards India. But remember that while it's incrementally positive that we are seeing more decisions being taken towards India, but the reality is that there are several countries which are actually benefiting meaningfully. Vietnam is a classic example with more than 30% allocation still. And more importantly, we are seeing that a lot of these countries are seeing decisions which are not just assembly, but in terms of components in other areas. So I would probably summarize by saying that, it's like, if I were to just summarize, I'll probably say that, look, we're clearly an incremental beneficiary, but not the only beneficiary. It will probably take 10 years for us to see it starting to impact the economy.
Okay, all right. Well, Venugopal, we leave it at that. Good that, we started the day on a positive note with you telling us that perhaps the worst of the fall is behind us, and you're expecting the base case is that the market should pick up in the second half of the year. Hopefully that plays out. We're close to the bottom, at least in terms of GDP growth for the country. So that's good. Thanks a lot for joining in, and hope your day goes well. Well, that's the word coming in on the market, which, by the way, is very, very quiet. There's not too much happening. At best, it's about a 60-point gain that we're seeing on the index. Okay, 52-point gain now, and it's held on to that. So there's no volatility which has played out just yet, and the market mood is optimistic as we start off trade. But let's invite the management of Indian hotels now on the show to get a sense of what demand and room rates are looking like. Remember, the company had told us earlier they expect an 8 to 10% jump in occupancy in the second half. There are also so many long weekends coming up. There's a recent note by UBS that says that there is no sign at all of any momentum slowing down. And there are so many triggers, right? I mean, there's the IPL, there's the G20 summit. So the hotel business has been booming. Puneet Chhatwal, Managing Director and Chief Executive Officer at Indian Hotel Companies, joins us now to talk about that. Puneet, good morning, and always great speaking with you. It's a subject all of us love, right? Travel, hospitality, the hotel industry. But tell us a little bit about the numbers. What has the occupancy rate been up until now in Q4? What kind of growth do you see, given that there are so many triggers? As I said, there's the G20 summit, there's the IPL.
Morning, Sonia. And the numbers are looking good. The occupancy is at high 70s when it comes to very important markets like Mumbai or Goa. There is hardly any market below 65% on a year-to-date basis. As far as Indian hotels is concerned, we are higher than 1920 on occupancy levels. We are operating at more than 100%. And as we reported at the end of Q3, we were far ahead on average rate. So our total RevPAR is trending around 30% above 1920 levels. And also on the total revenue, if we add the food and beverage, it's somewhere between 25 to 29% above 1920. So we are quite pleased with that. And also the business on the books and the outlook for the next 6 weeks or 8 weeks, because we don't have so much visibility, is quite positive, because after the conclusion of the women's IPL, now we start with the IPL on 31st of March. Then we have, as you said, G20. The wedding season starts to come back. So I think all in all, very pleased with the way the business on the books as well as the year-to-date figures look like.
All right. Hi, good morning, Mr. Chatwal. I put out a piece on the past Friday itself that the number of check-ins are way more outweighing the check-outs for the hotel industry on the whole. And going by what you're saying, well, that definitely is the case. I had a two-part question. One is on corporates as well as on international business. Now, have they reached those pre-COVID levels? I get the point that occupancies are better. The RevPAR as well is much better on the whole. But what about for both these two verticals? For you as a business, how much do they contribute? And are they at pre-COVID levels?
So domestic corporate is almost at pre-COVID level, and domestic leisure is obviously much ahead of pre-COVID. When it comes to foreign tourist arrivals, we are still less than 70% of pre-COVID. Till end of December, it was 60, but there has been some momentum in this quarter. So I think that number would come around 70. But we do believe, all of us in the tourism sector and hospitality, that in the second half of this year, we will cross the pre-COVID. In the second half of, the next financial year, we'll cross the pre-COVID level number.
Mr. Chatwal, hi, good morning. Prashant here. April onwards, what kind of, could you tell us what kind of price trends will we see? Because FY23 has been a good year, especially the second half has been super. Third quarter and fourth quarter also should be very good, as you're just outlining. But April onwards will, on top of a very good FY23, what kind of price trends should we see?
Nice. I think you'll see the same trend in Q1 and Q2, because the price is a function or a consequence of demand and supply. Demand stays strong and supply is restrained because of COVID. Not much activity happened in terms of finishing of hotels and building of hotels. So that is one. Second is, we tend to forget that around this time last year, we started seeing that, the third wave started subsiding. So there was still an impact, and IPL took charge in terms of driving growth in Mumbai and Pune, because the IPL was limited to these two cities. Having said that, Mumbai is a key for hospitality companies in India, so it was a good thing that we got that tailwind. But April, May, June, it wasn't as strong. So there is nothing that we know of today which would make me say that the rates and the occupancy should not exceed the April of last year or the May of last year.
Okay. Given that there's so much demand, right? Are you looking at raising any funds to support growth in the near future, and B, any inorganic acquisitions? You haven't had a history of that, but just asking if, now that demand is coming back in a big way, what would the opportunities be for the company, both in terms of raising funds as well as any inorganic acquisitions?
A good question, Sonia. I think what we did was we utilized the period of crisis to raise equity, both on a rights issue and on a QIP, and we were able to become a net cash positive company. We have no intention of raising more debt at the corporate level. And based on whatever results we have reported for the first 9 months and the outlook as presented, like you said at the beginning, by UBS and other analysts, we are expecting a good and healthy amount of free cash flow. So we are very well positioned to make any acquisitions from our internal accruals. And we have also, extended our partnership with GIC. So I see no reason that we have to raise funds. We are very well positioned with our own cash as well as partners like GIC to take benefit of any organic or inorganic growth opportunities that might present themselves.
Have you closed in on anything? Anything in this calendar year?
Sorry, I could not hear that.
Have you closed in on any inorganic acquisitions yet? I mean, anything in this calendar year that you would be hoping to close?
Nothing that we could talk about today, but what is important is we have an industry-leading pipeline, which accounts for almost 9,000 rooms, anything between 35 to 40% of our current inventory. We are having a record year. We have reported signings of new contracts with the pipeline at almost 3 hotels a month. We'll be ending at around 35 or 36 new hotels signed and 16 open. We were hoping to open 17, as I said last time on your channel. One has got a bit delayed because of some license issues. So in the next 2-3 weeks, even that will come in. So we are actually hoping to open 40 hotels already from the pipeline that we have over the next 24 to 28 months. So that is, and almost all of that is on an asset light model. So we are not expecting any kind of startup costs, any kind of big, startup losses or anything. They will all add on the basis of a fee-based model to our margins, to our growth. And if any inorganic opportunity comes, yes, we are there, but we'll, carefully check as we have made a lot of effort in last 5 years to get to the optimal capital structure.
All right. Puneet, I'm getting more nervous about the holidays that are planned for the next couple of years, going by the confidence you're speaking with. But, before we let you go, I was reading a Jefferies note and they highlighted 2 aspects. One is on the foreign tourists, which you've already updated us on. And the second point is on the Sea Rock investment. Now, being a Bandra boy, I asked you the last time as well. You said you're in discussions. You'll take a call in terms of investment. What is the update on the Sea Rock property? How much money are you going to put? Have all the clearances come about? Fill us in with a quick update.
We are halfway through the clearance. The file has started moving and now it has to go to CRZ for approval. And we are very excited because that would be a landmark for your part of town, Nigel. A landmark development together with the Land's End, if both can be connected. So it's not just a project for us or for Indian hotels, it's a project for the city of Mumbai and India as a nation. To build that icon, just like our founder built the one in Colaba almost 120 years ago.
Okay. Puneet, just one last question. For the international business, the fourth quarter is, there is some seasonality. I mean, margins are usually a little lower. I'm just trying to understand, will that, and that's about, international is about 10% of your overall business. So will overall, should one expect that impact to show through on a quarter-on-quarter basis on the margin front?
See, Q3 is traditionally for several decades the strongest quarter, and Q4 is the second strongest quarter. Now, we see no change in that trend, and there will be a marginal adjustment versus Q3 based on what we know in terms of how we have closed in on Jan and Feb, and almost we are getting to the end of March. So all in all, positive. I think the takeaway from this interaction should be that we are expecting all 4 quarters to be record quarters in terms of the top line and in terms of the conversion to the EBITDA margin. So there is nothing that we know that makes us feel differently about Q4, because Q1 was the best ever Q1, Q2 was the best ever Q2, Q3 was the best ever Q3. And I feel there is a lot of optimism around in the sector for almost all companies to have the best ever Q4. And obviously, we being the largest, we stand to benefit from that too.
All right, Puneet, thanks very much. But you know what they say, right? When you post best ever quarters, you raise expectations that the next will be, you know, the bestest, and the next after that should be the bestest after that. So
We'll come to CNBC and make sure it happens.
Thank you.
It's always a good problem to have, right? To post the best ever quarter and to live up to your high expectations, a great problem to have. But all the best. Thanks a lot, Puneet. And all of this talk about travel has gotten so much wanderlust in us. So perhaps we're going to, you know, go back and plan that next holiday. Thanks a lot.
Thanks very much
for joining in.
Thank you. Thank you for having me.
All right, let's step into a quick break and we'll move from hospitality to hospitals. Zamira Shah of Metropolis Healthcare will be joining in to discuss the healthcare sector, the sharp rise in COVID cases that we've seen. Later, we'll also connect with Vikash Kumar Jain of CLSA to talk about their outlook for the markets and a whole host of sectors as well. Stay tuned.
Kotak Protect